to Mutually Speaking by Navy Mutual. We are dedicated to educating military service members and their families on matters of financial security. The Navy Mutual Aid Association Mutually Speaking podcast is intended for general informational purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations, solicitations, or construed as legal or tax advice. This podcast is not meant to replace the services of a licensed financial planner, insurance counselor, or tax advisor. Programs mentioned and other information referenced in this podcast may change from time to time. If you have questions or comments, or if there's a topic you'd like to learn more about on this podcast, contact us at podcast@navymutual.org. This season, we are focusing on retirement and long-term financial planning. Today's topic is risk management. In order to do any sort of investing, you need to be willing to take risks. The type of risk we'll be talking about today doesn't involve putting your life on the line, but it does involve putting some money on the line. And sometimes that's harder to do. Fortunately, there are investment options for people with even a very low risk tolerance. In this episode, we'll go over the various types of risk that exist, strategy for managing risk, and what types of returns you might expect to get out of various investments. Here to speak with us today is retired Rear Admiral Brian Luther, CEO of Navy Mutual. Thank you for joining us, Brian.
Pleasure to be here, Kate.
All right, so this time we're going to start off just diving into risk. It's come up a lot in the previous episodes, obviously, because investments involve risk. But I think we're going to break it down to a more basic level and go a little bit more in depth. But what, if you could just get us started with, what is risk and how does it affect someone who's trying to save money?
So risk in the financial context here, I guess, could kind of be the risk that you have of loss of your funds, right? So if you're investing your money and you lose it, that's bad. So your risk can correlate to your rate of return. And so you can look at potential outcomes. So the severity of the type of risk and the possibility or probability of the risk occurring. And that's why there's so many different categories of risk. But if you, on a financial side, if you didn't want to have any risk on your money, you would put it into a money market fund and it's guaranteed by the government and you would get a very, very low rate of return, because the rate of return correlates to your risk. But if you wanted to shoot for the moon, you could find some biotech startup that's going to cure cancer, and your money could go from a penny a stock to $1,000 a stock if they cure cancer.
Right.
So you have a high rate of return, but the risk of losing your money is very high, right? And or you can have a very safe and not risk losing your money, but you would have a very low rate of return. So the possibility of loss correlated with the severity or the probability of the amount of the loss.
Got it. So then, are there different ways that risk can affect how you're investing your money?
Sure. Let's just say there are multiple types of risk that should be considered. It goes with the type of investment vehicle that you're using. So I just kind of talked briefly there about whether you're going with a money market fund or a stock, but you have risk in your market. You have risks with businesses. That currently in early 2022, the Fed is talking about multiple height rates. So there's interest rate risk. There's opportunity risk. You can hold on to your money, but every time you put your money into one investment vehicle, you're not using another investment vehicle, and so that opportunity is lost to you. So that that ties to the duration of the risk that you do. So if you buy a 30-year bond, you're locking your money up for 30 years. And so, 30 years ago, you could have bought Amazon. And so that's an opportunity risk there. There's liquidity risk. And just like I said, if you put a bond in for 30 years, it has a long duration and low liquidity. If you buy an ETF or a stock, you can trade it today, right? And then have it. There's currency risk, and in current events right now, anytime one country invades another, it tends to have negative impacts. And so the company that is operating in that nation, and in this case, whether it be the Ukraine or Russia, companies are leaving Russia. So there's market risk, there's company risk. They're not going to make as much because the revenue that they thought they were going to get from that country goes away. And then there's inflation risk. And again, that's why the Fed is talking about raising the rate. So when too much money is chasing too few goods, it raises the price of everything. And so you can see that this last year too is particularly with cars, right? There hasn't been a lot of chips, and so they can't make a lot of cars because cars need the chips. And since there's not a lot of cars, and people want to buy cars, the price of cars have gone up. And when the new cars haven't been available, then people have gone to used cars. And you can see now there are some used cars that were bought a year or two ago that are now worth more than when they were purchased. And that's inflation.
Yeah, no, we've been shopping for a new car, and my husband and I, and we were looking at used as well, and some of the used cars are actually more expensive than the new cars.
Really?
Yeah.
Right.
Yeah, it's baffling.
Right? So it's just that, so there's a lot of people who have free cash and they're driving up the prices. And
Right.
and that would correlate to a stock too. Once everybody finds out, hey, this stock is the best thing going, and they get very popular. You can think of the pandemic stocks, right? For a while, everybody said Zoom is going to be the only way we do business, because during the pandemic, it was the only way to do business in the beginning. And so a lot of people chased the Zoom stock, assuming that it was going to be the primary means of business communication going forward. And Zoom is now, now that the reopening is occurring, people are dumping Zoom because the market doesn't support it, because the business is not generating the revenues it was in the height of the pandemic.
Right. Well, and then anytime anything becomes popular, you get a bunch of other businesses following on, and then they break up the market share. Yeah.
The cure for high prices is high prices.
Yeah.
So once people see there's a profit to be made, you're right, then you have other companies come in because they want to get a piece of that pie.
So then I think all of these different types of risk also go back to what you've been talking about a lot of finance being personal, right? And so this would have to do, I'm guessing, with your own personal tolerance for risk and what types of risk you're kind of okay with dealing with.
Right.
So the type of risk that you're personally okay with, like you were talking about earlier about putting all of your money into a CD. But to me, when we're also talking about inflation, then you're running into a different risk, correct?
Absolutely. Right. So if you put all your money into a CD and you're getting 1%, or you put it into annuity and you're getting 2.5% or 3%, but inflation is running 7%, then you're losing 4% purchase power, 5% purchase power every year. So what you could buy for $1 this year, next year, that dollar would only buy 95 cents of an equivalent value because you lost your purchase power. So part of your time horizon has to influence what you're doing with your risk. So that personal risk tolerance is what you feel comfortable. My personal belief is your money and investments should generate peace of mind, right? And so that peace of mind is a corollary to your risk tolerance. So if you look at your investments and your savings and you don't want to see volatility in that, you don't want to see the ups and downs, then you would have a low risk tolerance. But if you want to shoot for the stars and retire early, you might take a higher risk. Um,
Sure.
and so for portfolios, they call that beta. And so for all those types of risks that we talked about, when you or your financial advisor or the news article that you read that has portfolios, like for TSP, right? They have life cycle funds, and those life cycle funds allocate across different investment vehicles. So TSP has the G fund, which is the bonds, money market. It has the F fund, which has fixed income. It has small cap stocks. It has large cap stocks. And it has international stocks. Well, the G fund is the least volatile, changed the least, but it also has the lowest rate of return. And the capital or the investment, the stock based funds, have higher rates of return. The international one, I think, has the highest volatility, but the life cycle funds will allocate across those five funds based on your age. Because if something goes south with the market, like the correction that we're currently going in, or the big divot that occurred when the pandemic first hit, if you have time to recover, then you can invest in a riskier investment vehicle because there's time for you to recover, and you can reap the benefits of those higher rates of return as time goes on. But the life cycle funds, as you get to different stages in your life, they reduce the volatility and transition you into a 40%, 50% of it in fixed income. So you get a higher guaranteed rate of return, but at a much lower rate. But because of longevity risk, the fact that we're living longer and we could outlive our money, they want to make, you can never get out of stock completely. You need to have something that's generating a higher rate of return so that you don't run out of money before you run out of life.
Sure. Yeah, no, and that time horizon thing has come up several times, and it did make me think back to we had at Navy Mutual, we had a financial advisor come in to talk to staff, and he pulled up a graph of the 2008 crisis of people who had investments, and the people who panicked and pulled their money out in 2008 when the crisis hit, versus the people who just left their money in. And the difference in like the next 20 years, I mean, the people who pulled out lost around $1 million. And that might not be totally accurate,
right,
but the gap was very large.
Right.
And that just made me think, oh, wow. So it's almost like you just got to bite your tongue and just hold strong.
Right. And it's the time horizon. So on average, over any 50-year period, if you took the stock market and you just dropped a pin and then went 50 years and then you dropped a pin, you went 50 years, on average, it's 7 to 9% rate of return. But those people that time the market and say, I'm going to buy at the bottom and sell at the top, nobody can predict the future like that. So that's why certain investment strategies like dollar cost averaging comes in, right? So you say, I'm in it for the long haul. I'm betting on America, because the reason why the stock market goes up or has gone up writ large, right, is because the American economy has continued to grow decade over decade over decade. And so if you're willing to bet on America, I think that the economy is going to continue to grow, then there's no reason why the stock market shouldn't grow as well. But that being said, there are companies that were powerhouses in their day and didn't make it.
Right.
Right. Kodak as an example, right? For when I was growing up in the last millennium, Kodachrome and Kodak and pictures and the little camera hut houses where you would drop your film off and get the film developed so you could get the pictures. And it's a classic business school case. Kodak is the one that actually developed digital pictures, but they didn't want to pursue it because it took their primary revenue stream of print paper and making pictures.
They couldn't see the forest for the trees.
So they wanted to protect their current monopoly. And so instead of pursuing the digital and seeing that as the future, they stayed with the print, and so Kodak is not the powerhouse it used to be, right?
Right.
So, but as you mentioned, right, new companies come in. There's creative destruction. Amazon started as a online book sales, and all those bookstores where everybody went in and had their espresso and checked out a book, and then they all went away, and everybody bought their books from Amazon, or now they buy digital books, and so the whole market shifted. So if you're invested in the market, you get to take advantage of those companies. But if you hold too long, your investment that was good for years and years and years, could go away. So you have to. It's like a garden, and you need to continue to nurture your garden and track what's going on with your investments.
Yeah. So you mentioned the dollar cost averaging, and that's one of the risk mitigation strategies that are out there. And then talking about different companies and hedging your bets a little bit. That would fall under diversification, right?
So you have multiple types of risk, and then you have strategies to address each one of those risks. So I talked about the market risk. That's kind of where we were talking. So you can buy stocks, you can invest in real estate, you can invest in a mutual fund, which will get you into a sector, or an ETF, an exchange trade fund. So when you have time, so that long haul investment that we were talking about, that is critical, and time is your most powerful weapon in your investment portfolio. And then the next thing that will generate your rate of return is your asset allocation. And so that asset allocation means how you diversify your investment. So as I talked earlier, if you want to worry about market risk, and you say, hey, I'm worried about these businesses, then you can go in and you can set an asset allocation. You say, well, I like the stock market, but I don't like retail. I think retail is dead. So I would like to go into a growth stock, or I would like to go into a more conservative utility stock. So you can buy a mutual fund or an ETF that is sector driven. And so you can hedge your risk by saying, I'm going to allocate my assets into this field, right? But I want to diversify my asset allocation across multiple. So if you take a look at the different risks that you have, whether it be the business risk or the interest rate risk, you can modify those inside your asset allocation, so that if you say, if interest rates go up, my growth stocks go down. So you allocate some into a money market or a bond fund, and some into a growth fund. So when the interest rates go up, your fixed income will go up from the bond fund, but your growth will go down. But your portfolio, you've modulated the amplitude of those two volatilities, and so you won't see big spikes that are going up or down. But if your asset allocation is all into growth, like last year, you couldn't lose if you had invested in 5 stocks, right? The FANG stocks, so Facebook, Apple, Netflix, Google, right? I mean, Amazon. Those 5 stocks made up the largest rate of return, the greatest portion of the rate of return for the stock market. But once interest rates started going up, those stocks started dropping precipitously. So if your asset allocation was high into growth, you saw tremendous rates of return. But then once the cycle changed, right? So we have value cycle, growth cycle. Once the money starts shifting to the other asset allocation field, then you saw your technology stocks drop. And kind of like what we were talking about, the pandemic, right? Peloton could do no wrong. Beyond Meat could do no wrong. Zoom was doing no wrong. Peloton is, the price has collapsed, right? Beyond Meat has lost its lofty valuations, as has Zoom. So if you allocate into one area and it does well, then that's your cocktail conversation. Everybody talks about their good stock picks at the party, right?
Yep.
But if you don't take some of those chips off the table and allocate them into something different, right, then you're bearing more and more risk, market risk in that case, or business risk. So when the business model doesn't work, then the company is going to fall out of favor, and then the stock price is going to go down. So people will call that balancing their portfolio using asset allocation, right? And so and asset allocation is really a diversification of what risk categories you want to use.
Yeah, so just overall, you're sort of managing the potential for loss by spreading it a little
Across,
bit. Yeah,
put
spreading it across.
loss or gain, right? So yeah, so and it's all about balancing. And so there are some folks that recommend, you fix your risk, you determine your risk appetite, and you can set a goal and say, I want to invest. I choose to retire at this age. I need this much money to retire on, so that because I will shift to a fixed income strategy at some point in time, and then so I will reduce my risk and generate a fixed income. And so if you know what your time horizon is, it just becomes a math problem. I have this much money to start. I'll invest this much periodically. It needs to grow at this rate of return to generate this much money so I can turn it into a fixed income stream, down the road. And then you can take all that volatility and then just adjust it to where you want to go. And you can adjust it across 12 items, or you can adjust it across 3 items. To whatever your risk tolerance is.
Sure. And then when we're talking about like adjusting and allocating within the TSP, are you personally able to adjust, like, say you wanted to go, I don't know, 5% into the G fund and 10% into small cap? Are you able to do that yourself?
You are. You can create your own life cycle if you want by because they use those 5. So they only have 5 tools on their tool belt, right, for those 5 funds. And you can look on the TSP webpage and see what their historic rate of return is, and you can kind of gauge that from there. And so, yes, you can allocate your assets inside of that TSP portfolio and generate, rate of return. So if you say, I'm too young to put money into a fixed income, I need this time to grow, then you can go. The old adage used to be your age was the bond percentage of your portfolio. So the older you got, the less risk you had in your portfolio. So if you were 50,
Gotcha.
50% of your stock would be, or 50% of your investment portfolio would be invested in bonds, right? So there was all these rules of thumb. And then once you retired, you could take 4% out. But as they've gotten more data and they've seen that, in fact, people live longer, now they have to take a look at that 4% or at the asset allocation. So that's the longevity risk I was talking about. So if you look at your family history and determine your genetic lottery and say, okay, this is how long my grandparents lived, and this is how long my parents lived, and I'm assuming that medical science is getting better rather than worse over time, and we take better care of ourselves, then I expect to live at least as long as my parents and maybe longer, right? So that you need to be saying, can I take 4% out with 50%, 60%, 70% bonds in my portfolio and still have the money last until I'm 88 or 92 or something like that?
Right. Yeah. Well, and now you've also got that whole movement of, I think what's it called? Retire early.
Financial independence, retire early, right?
Yep.
Yes, and then there's fat FIRE and there's thin FIRE. As people say, I'd like to have a little bit more. That's the fat FIRE, or the thin FIRE says you can live on even less, right? But that FIRE concept is exactly what I was talking about. If someone sets their life goals and says, I don't need a big house, I don't want a big mansion, I just want a small 1 or 2 bedroom house, and travel is more important to me than possessions. Once you pay off a small house, your housing expenses drop significantly, right? You're just
Right.
paying taxes and maintenance and upkeep, right? As opposed to paying the mortgage every month. And that, if you're driving to a fixed income lifestyle, whatever you can do to get those um, fixed
Monthly
expenses off your cash flow statement, right? That's the best way to go. So they will sit there and say, I am choosing not to have a big house. I'm choosing not to have a vacation house. I'm choosing to have one house and use cars. But once I have enough in my portfolio that can throw off using a safe rate of return, then if I can live on $40,000 a year and my portfolio can generate $40,000 a year, then I'm good to go.
Yeah. Wow. More power to those people, but I don't
Right.
think I'm that disciplined.
Right. But the interesting thing is, some of them have done very well with their stocks, the TSP millionaires, the 401k millionaires, and say, hey, I can retire. And then they leave the job market, but then being retired for 20 or 30 years, right? That's a long time to be retired. There's, on the longevity side, there's actually some studies going on that said that the first 126-year-old cohort of people are being born now.
Wow.
So in this 100-year life, if you are going to have, so our children or our grandchildren, if they are going to have a 100-year working life, they will not have one career. They're looking at they'll have probably 2 or 3 careers. So you'll have a career for 20 years, from your 20s to your 40s. You'll retrain and have a second career to take you from your 40s to your 70s, and then you'll have your final career that takes you from your 70s to your hundreds, and then you retire at 100, and then your retirement takes you from 100 to 125. So
gosh, I would not want to be working when I'm
so
100.
well, but if you but that's the thing, right? If you are sitting there and you're going to live to your 120,
Sure.
even if you're going to live to your 100, right? In today's day and age, if you don't have a defined benefit plan that is going to guarantee you have to generate the investment. And Social Security was never meant to be a retirement fund, right? It's a supplemental that's to help widows and orphans or injured people that couldn't continue to work. So the only way you're going to be retired is and not work is if you invest long enough and frequently enough to generate something that you can live on in your retirement.
Sure. Yeah. Well, and then there's also people who just get bored in retirement. You know, you think, oh, I want to retire early, and then you're like my dad.
Right.
He's doing retirement wrong. It's like been 3 years since he retired, and he's like applying to jobs and he's taking contract work. He's just bored. He just he just want to sit at home all day.
And so it's and again, retirement is as significant a decision as your career selection, right? So you have to figure out, and you will be retired, 20, 30 years. In the modern age, right? When Social Security was first developed, there was, a 3 to 5 year window that the life expectancy of Social Security recipients. So you weren't like in today's age. Do you take it at 67? Do you take it at 62? Do you take it at 70? Well, the break-even point is 81. Well, the life expectancy for American citizen was at 81. So people took it at 62 because most of them had passed by 67. Right. So that window for Social Security has increased as our life expectancy. So longevity risk is one of those concerns, and then that's where long-term care risk comes in as well, right? Because if you don't take care of yourself, live longer. Your retirement is going to be less enjoyable if you've lost the mobility that you used to have. So you can't do the traveling or the activities that you choose.
Right. So it's not just investments that you need to mitigate risk for. It's also long-term care planning. It's, where you want to live, what your lifestyle is going to be.
Right.
Interesting. Well, now that we've gone through a bunch of different risk mitigation strategies and risk tolerance and the different types of risk, what would be sort of your key takeaways just about risk and how people can move forward? Or
So I guess the key takeaway is, as I've said before, personal finance is personal. So what's the physician, heal thyself, investor should know thyself. So as you go through, you should understand, one, what is your goal? Like, what are you working for? Because as we said earlier, time in the market trumps almost everything else. So you have to know what, and it'll help you figure out your investment plan if you know what you're investing for, what the goals are. And then you can use that long-term plan to do your asset allocation, right, and diversification inside the different types of investment vehicles, and then you can address all of those risks. So have a plan, understand what done looks like, and then it's, as I've said before, it's not the frequency, or it's not the amount that you invest, it's the frequency that you invest. So if you're frequently investing and doing it over time, and allocating to your stage of life, you'll get to your financial goals.
Great. Well, thank you.
Thank you.
There are no guarantees when it comes to the market, but it's useless to try and avoid all risk altogether. Without risk, there can be no growth. Even if you have a relatively low risk tolerance, you can still make smart investments that will benefit you in the future and outperform the rate of inflation. Before making any decisions, though, it's important to do your research. This basic understanding of risk can be supplemented by talking to a financial planner. If you're active duty military, you have access to free financial planning through the DoD Office of Financial Readiness. Thank you all for listening, and thank you to our guest. And join us for our next episode when we will be discussing the various types of retirement income sources. Visit info.navymutual.org/mutually speaking to access resources and information related to this episode, or submit a question to podcast@navymutual.org.